I guess, I'll kick it off and introduce some of the other folks as well. I'm Francisco. I work at a nonprofit. I also have a small fintech called Unidos, and I talk a lot about finances, personal finance, mostly focused on credit and debt. I think this whole thing kind of started by Paul talking in the Slack channel about, hey, would anybody interested in talking about investing? And I said, sure, I'd share some. I have some experience in the finance space. I tend to focus on credit and debt, for my company, but I thought it was an opportunity for me to share some information and opinions that I have about investing. And then, we kind of talked about very briefly last time some of the foundational stuff, credit and debt. That's a core component to financial wellness as a whole, right? I think all these things are so multi-related, and they're all very connected. And so we thought it would be best to kind of split them into two talks. And today's the other section. So hope you guys enjoy it. So we're going to do introductions about myself, Juan, and Paul. We'll talk about money, and then we'll give the opportunity to just kind of have a dialogue. And we really love for folks to feel free to video chat or ask questions in the chat if you'd like. You could just directly, have a discussion. I love the opportunity to just share opinions and experiences whenever possible.
Yeah, I'll try to monitor the chat too.
Yeah, no, thank you, Paul. So I'll start with myself. I'm Francisco. I love data. I love math, I love finance, and I love learning about a bunch of new stuff, whether it's, with respect to computers, mathematics, statistics, or, other random things.
My name is Paul. I love Xbox. I like CSS. I love CSS actually. And then Star Trek and physical science. I like specifically the space physical science. But yeah, that's it.
And I'm Juan. I love to travel. I love finance. I love technology, and I love football. I come from the fintech space, and I've been working on that for the past 6 years, and it's been pretty fun so far. A lot of COBOL, which is not so exciting, but it is what it is.
And so, I wanted to share a little bit about my background, why I think some of my opinions might be relevant. Feel free to disregard them. I share them only because I think I have a little bit of industry knowledge, just based on my experiences working in the space. And just to kind of give you the brief version, I graduated from high school, like most folks, not all folks. And I did my undergraduate degree in economics. I did my first master's in economics and statistics. I then went to work for Ipsos, which is a large market research firm. I spent a year working there. I then had the opportunity to work at AIG, the big insurance company, back in 2012 when they started creating a data science department. They're one of the early adopters of data science space. I spent a couple of years working on there a lot on underwriting, catastrophe modeling, and the commercial side of underwriting. And those really interesting experiences. I then got the opportunity to work at the Commonwealth Bank of Australia. It's a huge Australian bank where we were launching digital banks for consumers in emerging markets, particularly South Africa, Indonesia, Vietnam, India. We actually shut that one down, and then China. And so that was a really interesting experience because I got to work on a variety of different problems, not only on the consumer, but also on the commercial side. And then all of the core underwriting, data and analytics to support all of that. I did my second master's in data science and machine learning at Columbia, part-time. And then I had the opportunity to work at Goldman Sachs in their consumer business, Marcus. In the first product they launched, Marcus, there I led the data and analytics for the core underwriting for fraud, credit, and I worked as a strategist for the consumer bank, and spent a lot of my time focusing on data and analytics. After a couple of years there, I decided to start my own company, Unidos, where I just wanted to essentially take all the knowledge that I had acquired over that period of time, and share it with folks about consumer finance, how you can use credit and debt and really good habits to improve your own financial well-being. And so that's what I focus on in my leisure time, I guess.
I've already said my name is Paul, but my business is 132 Design. We create brand design and digital strategy for startup businesses and basically like startup to mid-sized businesses. We try to focus on people that are a little bit more outside the box thinkers. Aside from that, I'm fascinated with the way money works. I'm really like dead set on trying to make sure that my family's safe even after I'm gone. So that's why I'm constantly asking questions about money and how it all works. And then as Francisco mentioned earlier, the goal, especially I was so happy that they could even existed, but also the fact that it had a finance channel where you can ask questions like that. I kind of want to plug in, if it's okay, that we're going to do a book group starting. I think our first meeting is going to be next week. But Ruben, if you look in the finance channel, Ruben's in there. He's heading that up. So wanted to give that a shout out. So if anybody's interested in joining that, as with this and all other things that we're trying to do, I hope it's a relaxing atmosphere and we can all come together and learn about money, right? And that's me.
So I'm Juan. I was originally born in Colombia. I'm very passionate about finance. Why is that? Because I love numbers. I come from a little different background from perspective as most people. I've always been around finance all my life. My educational background is computer science and finance, and I work in the fintech industry. Actually, one key fun fact about me is before I even got into the fintech industry, I worked in the auditing industry for technology. So that was pretty exciting. Um, so believe it or not, working with the big four and seeing that they didn't know anything that they were doing and being able to tell them what to do was actually kind of exciting. Um, and yeah, I've kind of joined this path from their situation because Paul had been asking, general questions about how mortgages work or, how is this really going to impact? My current role in fintech is really based on car lending and mortgage lending. Been doing that for a few years now. So I basically take anything up from where you start or originate a loan, and then how do you go through that process through underwriting and then be able to service that loan afterwards after the loan is done. So there's actually a lot of complexity behind that, and should be able to share some details about that and give you guys some insight on how that works. And hopefully when you're looking to do your next fixed purchase and you're figuring out how lending really works, you can use it to your advantage, coming forward. So hopefully that'd be the end goal as well as we educate people.
Great. So, we talked about this last slide, but yeah, I always think it's worthwhile to do these introductions and to say, what have we learned with all of our different experiences and our backgrounds? And I think it's just important to emphasize that the finance is really complicated, at least when you go to it and you haven't worked in it, right? And I think it's for a variety of different reasons, right? For some of us, I know for me, it wasn't introduced in school. There's a ton of information out there. What's good, what's not. There are generational language barriers that exist, right? Like my parents are both from Mexico. They didn't understand the credit system. I love my parents. They didn't have the same access to information the same way other folks did, right? And the industry doesn't necessarily do a great job of focusing on making that information accessible. But what's interesting, what I feel like I've learned, and Juan, feel free to speak up here. I think the logic and the math behind all of these different pieces of finance is actually very similar. It's actually very easy to understand once you strip it down to the basic components. And so it doesn't have to be complicated.
No, and to add to that, one of the things is it might look like a lot at first, but breaking it down to technical terms, when you start with just hello world on any language, if you just start to that small and build it up, it becomes very clear down the line.
Yeah, exactly. So money, I think money is important, right? And I think it's important because it controls your life whether you want it to or not. I know my parents, they often said that, money's not everything. And I agree, it shouldn't be. But I also think that, money can protect your life. It can protect your loved ones. Um, so you kind of have to be able to work with it, understand it, in order to be able to use it in a really healthy way, and still while balancing the fact that, like, look, maybe money is a means to an end. Maybe you love money. That's fine too. Nothing wrong with that, right? You know, tons of people love money. That's okay. But it also, it's important to be able to have a healthy relationship with it. You know.
Yeah, I think the less the more you know about your personal money, right? The less scared you are to make decisions. I think that's some of the things that we're going to try to answer here, right?
Yeah. And so I think, you know, obviously coming out of that, at least for me, what I experienced is I had a lot of fear about money. You know, when I was, you know, coming out of college, I didn't have a lot of money. You know, I didn't have any money. And I was afraid to look at it because it was just like, well, shit, I just am broke. I don't want to acknowledge it. It was like this boogeyman, you know, and I didn't want to face it. And that was an approach. I think eventually I was able to learn to face it and start to get control about it. And so I made this meme-like diagram. And really what I want to emphasize is that, like, you know, if you're not afraid of your finances, great, and you're on track. But if you are, um, don't do what I did. And what I did was I was just like, you know, I'll let the future me figure it out. And sometimes I still do this, and it's a struggle, right? But I always thought, you know, future me would figure out everything, figure out my money, and figure out my plan for my career, or you know, how to, you know, not be an idiot about something. Because future me always had, you know, things easier, right? But the problem with that is that um, you're punting it, right? You're letting that other person solve it, because then you don't have to solve it right now. And then once I realized that, I started to say, like, oh no, actually, present me right now needs to grab a hold of it, and try to force it into a way that works. And so I think moving on to that, or moving on from that, right? It's well, how do you take control? How do you not be afraid of it? How do you make a plan? And I think the first step, the foundational step, is budgeting. You know, I love investing. I think it's a great thing. I've spent time working the quant side of it. It's awesome. But in order to get there, there are certain foundations that you have to have. And budgeting is, in my opinion, the core foundation. And to be transparent, I was not a great budgeter for a long time. You know, in part because when you don't have a lot, it's hard. And then when you're first figuring out, at least for me, it was hard to learn it, right? Nobody gave me instruction, or at least I felt like nobody did, right? And so we came up with this kind of framework for it, right? How do you take control of your money? And I think by taking control, you can actually fight that fear. You can control it. You can force a strategy, and then be aware of it. And then that can be empowering. And so, you know, the questions that we hope to answer are, you know, what is a budget? Do I need a budget? How do I start a budget? And how does a budget prepare me for the future, right? And as I mentioned, you know, the kind of core things that I believe in, that we believe in, I think, is, you know, that there are three foundations or three pillars to financial wellness. You know, budgeting, debt, and wealth. You know, debt seems like a strange one, but we'll go more into how that's a great one later. And so budgeting, right? What is a budget? I think if any folks have ever heard anything about Dave Ramsey, he's a pretty influential person in the budgeting space. You know, he has like the debt-free community. You know, I think he has some separate opinions and other things as well. Well, I'll refrain from those. But he has this view of the world of the 50-30-20 rule, where, you know, your income should be split into 50% needs, 30% wants, and 20% savings. And I think that's not really helpful. Because if you look at the average income or the median income for a household in the US, and if you just look at the empirical facts about what the state of most folks in the US are, this is unrealistic, right? It's just not obtainable. And so by saying something like this, sometimes it alienates people. It makes people think like, well, I'll never hit that, so why even bother? And that's an opinion of mine, right? You know, I don't think that helps people. I know that when I was in a harder financial situation, if I would have seen this, I would have been like, whew, yeah, I'm definitely not doing this. I don't even want to, I guess I won't even start, right? But that said, I think Dave Ramsey does have some other good points, right? And the point being his quote, you know, that you must take control of your money, or the lack of control will forever control you. And I think that's a powerful thing.
I think it's something that we've been kind of reiterating here. I mean, it's just that either, and it's so powerful what he says there, because you know, if you let anything turn into a snowball, it's going to grow no matter what, and unless you actually do something about it. And so that's where the power of budgeting comes into play.
Yeah, you know, to add to that, I think the biggest thing at the end of the day is having knowledge, right? Knowledge of where you are at and where you sit, regardless if it's a lot of money you have left over, a little bit of money left over. Knowing is power, and being able to make the right decisions going forward, having that knowledge is a bigger factor than anything else. So, you know.
100% agree. So I think a natural question is, well, do I need a budget? And I'd say absolutely yes. Everybody's balling on a budget. It's just sometimes some people have like $1 million or 100,000 or, you know, 30,000 or 40,000 or whatever, right? And there's no harm, right? It's just a budget is just doing some math on whatever your finance are, right? And so I think when you just strip it down that way and then separate at least for me, when I just said like, oh, this is just math, then I was more open to looking at it, right? When it was me when it was like me myself looking at my own money, then for some reason I struggled with that. But when I said it was just like, oh, this is just numbers, and I took the emotion out of it, it was easier for me to separate and look at it and say like, oh, okay, let's actually think about this a little bit harder. But you know, there are other benefits too, right? Because by looking at it and putting it on paper, you're going to be able to reduce the uncertainty about it. You'll be able to be calculated and actually say, well, this is how things add up. That's right. As I said, you know, unless you're a billionaire, you probably need a budget. And even if you're a billionaire, you probably have hundreds of people budgeting for you. And, you know, most importantly, you work really hard for your money, right? You spend probably at least 40 hours of your week doing that. That's a lot of time. And so you should be intentional with how you use it. Sorry, go ahead, Juan.
Oh, I mean, so from my perspective, right, is at the end of the day, you are trading your most valuable asset, which is time, for money. So if you're trading your time for money, you want to be able to see what you're doing with that later on and being able to manage that. So later on in life, when you do have and you want to spend your time, not necessarily trading for money, but to doing other things, you're able to do that and have the mind space of, I can do this without having any issues.
No, exactly. And so this chart, I'm going to explain it here in a second. What I wanted to highlight in here is how important budgeting can be. Because especially when you're young, you know, it might not seem like you have to save up all at once right away. That's how I thought, right? I thought like, you know what, again, that future me would figure it out. You know, when I first moved to New York, like I said, I didn't have any money. I just had, you know, books and a guitar, which is dumb. And I thought, you know, maybe in a few years I'll be able to save money. And had I budgeted a little bit harder, I would have been able to actually get a lot farther. Because what you'll find out is that time, when you're saving and you're setting up financial goals, is your best friend. So in this example, what I've done is I've used a calculator to just highlight what happens if you're, you know, supposedly making like $45,000 a year, which is not a ton of money, but that's not, you know, less than the average individual working in the US, right? And I assume that 5% of your annual savings after, adjusting 30% for taxes, and that's a silly assumption, but that's fine. Oh, actually, this one doesn't. Sorry, apologize. Yes, just assuming that you're saving 5% of $45,000 a year, and let's assume you got like a 3% raise every year. Then if you started at 30 years old, by the time you went to retire, you would at 65, you would have saved $1.1 million. That's a lot. That's a lot. But if you started at 25, you would save $1.6 million. About 60% increase by starting 5 years earlier. And that sheer fact is driven by compound interest, right? Because every year it's growing by maybe like 5%. In this example, I assumed 5%. And then the next year it's again growing by 5%. But 5% times 100 is, or 105% times 100 is 105, right? And then 5% times 105 is more than 105 plus that, right? It's growing at a higher growth rate. It's not growing linearly. And by using that fact in time, it'll grow a lot faster for a lot longer period of time, right? And so now if you start at 22, it'll grow to $1.9 million. You start 10 years earlier and you nearly double your money. And so compound interest can be so powerful. And the point is that if you start budgeting earlier on, you can have a really profound effect on your life over the course of your years. And it doesn't have to be a huge amount, right? In this case, it was $45,000, 5% a year, right? You're not adding more, but to try to play catch up with those, you have to end up putting a lot more on later in life to try to catch up, right? And so like I said, here having a budget and starting earlier is the great way to have really strong financial wellness.
Yeah. Also, if don't if you're old like me, you don't want to say, "Hey, I guess it's over for me." No, I mean, start saving as soon as you can, right? So this is where I take over here, right? All right. So this is how do I start a budget? A budget is both a strategy for your money and a way to control of issues head on. Biggest keyword there is control. We keep saying that over and over again, and I think this is where it becomes really powerful. You're going to determine your income, so you're going to see how much money you bring in every month, consistently, right? Because you don't want to, if you can't rely on certain things, and maybe you'll add that as a bonus. Let's say, for instance, if you're working freelancing on top of your normal job, you would want to focus, and this is my opinion, you would want to only count what you make consistently, and then add up your expenses. Calculate the difference. And then this number 4 is the powerful part. Set up specific goals. And then what are you trying to accomplish with that money that you have? And then finally make a plan. When you make a plan, well, this is an idea of how you can actually make the plan or how it can look. I'm going to show you how I budget my money. I didn't want anybody to laugh at how much money I make. So I just figured that I'd show you an imaginary one. That's okay.
That's fine.
Go ahead. What were you going to say?
We were going to show the demo a little bit in a couple different slides.
Oh, I'm sorry.
Okay. It's okay.
So I'll hand it back over to you. Did I do it right?
No, yeah, I can share. We'll get to that part. Sorry.
Yeah. So we'll go more into depth about this whole process in a few slides, right? So sorry about that.
No worries. The only thing that I'll add to that is that after you make a plan and have those goals, sometimes things change, right?
Mm-hmm.
Life is crazy. Maybe you have a kid, maybe you get sick, or maybe you have a family member that you have to take care of, and that's okay. That's what having the budget is for, to save and prepare for life's innate chaos. And so there's always opportunity to revisit the plan, right? Just because you have a plan doesn't mean you have to stick to it. You just have to be open to evolving to it, right? And so I created this really hard to look at graph, and so I apologize for it, but I'm going to explain it because I think it can be really helpful, right? And you know, I think some folks can relate to this, some folks maybe not, right? In this example, what I wanted to do was highlight maybe a single person, right? And you know, you start working at 25 years old, great, and you start, you know, saving maybe 5% a year, and maybe you're making $50,000 a year, so that's 10% of your income, which is a lot. That's tough, but those are hard goals that maybe you do hit, right? And then over 5 years, from 25 to 30, you save up $25,000. That's fantastic, right? Over another 5 years, that's $25,000 again. You're at 35. You've saved up like 50 grand, and then maybe you double your salary or something, right? And you start saving, you know, another 5 grand on top of that a year. So you're saving 10,000 every 5 years. And then, you know, you save another $50,000 over the years. So by 40, you've saved up to $100,000. That is fantastic, right? You're crushing. And then another 5 years go by and you've saved up another 50, right? And then at 45, maybe you have a life event, right? Maybe you decide to put a down payment on a house, or maybe you have a really expensive child, or, you know, maybe you just live in the US with a broken healthcare system where it costs you this much to have a child or something. You know. And so, okay, you spend 20,000. That's a lot, but it's not everything. That's you've saved up $150,000, so you're okay. You're at 130, right? And then let's speed it up a little bit. You're, you know, at 60, you've saved up another $150,000. And then maybe you have another life event. Maybe you fall ill, or you have an incident, right? Or maybe you know, someone you loved has a complication, and then you pay for it. That's fine, right? Again, all good, all how you've been prepared for. You've been saving, handling that risk, right? And then at 65, you save another 50 grand over that time. And so you're at $300,000 in the time it takes you to save. Now, this ignores compounding interest, and this was just for the sake of doing some arithmetic, right? But what I want to highlight here is that if you have $300,000 by the time you're 65, which is the time you can file for Social Security and retire, well, if you spent $10,000 a year, or $30,000 a year, you'd be done in 10 years, right? Which can be challenging. And there's a bunch of things that you can do to resolve this, right? Like, because obviously the world doesn't work this way, right? There's ways you can grow your money by putting it in different portfolios with different returns, right? And grow some aggressively over a long period of time to get 18% year returns, right? Or some others that you know, have some interest, and you know, maybe you get like 5% over year, and you know, you try to live off the interest in your remote location, and that's okay too, right? Those are all fine. Those are all things you can control. But even looking at this, right, and looking at the scope of your life, it can, at least for me, when I wrote this down on paper the first time, I looked at it and said, wow, okay, I need to be very intentional about planning for the future. Because, you know, maybe I'll die tomorrow, right? But that's fine. Yeah, at least I've prepared so that, you know, my wife or my loved ones or my family, my parents are in a good spot, right? And then just in case I do live until I'm like, you know, 80 or 90, I'm also in a good spot to be able to be financially healthy at that point, you know, and be able to take care of myself.
The only thing that I'll add is, you know, it's never too late. There's always ways around it. It's never too late.
Yeah.
It's never too late.
I was going to say too, like somebody once told me that you're actually trying to help the 75-year-old person out there, your future you know, set him up, because that future you doesn't want to be, you know, working, grinding it out, you know, because the present you isn't taking care of business at the moment. And so I think the planning part is just so important.
Yeah. No, I 100%, and I 100% agree with Juan and Paul, as he said before. It's never too late to start. I know I started, here at 25. In my adult life, I did not start at 22. I didn't have my shit together. I'm just gonna be very honest, and that's okay. I've managed to figure it out a little bit. I'd like to think, but there's always time, right? And there's always a benefit to having these good habits. And like I showed before with compound interest, if you're younger, great. If you're a little bit older, that's okay too. Having these good discipline, this good strategy is going to help you for the rest of your life, right? And hopefully with a little bit of planning, we can set it up for success. So, the last point I want to make about budgeting before we go into this awesome demo that Paul has kindly prepared is that budgeting is not like a bullseye. I always thought that it had to be like, you either get 100% or you're terrible and you don't know what you're doing. And that's not true. Actually, it's more like, if you're if you're just playing the game, right? If you're just hitting the dartboard somewhere, then you're already ahead of the curve, right? Then you're already on top of it. Because humans aren't calculators. Even me as someone who predominantly functions in calculators, I don't behave like a calculator, and that's okay. I look at things. I had a plan, never meets it, but I'm like, oh, okay, cool. This is what happened, and then I just move on and adjust things where I see fit, right? So long as you're looking at things, you're already in a good spot. You're already playing the game. Paul, did you want to share your screen and
Sure.
share it down, please? Thank you.
Let me see which screen. Okay. I hope everybody can see it okay. Can we see it okay?
Yep.
Okay, good. All right, so this is just one tool. I've tried so many different tools. A bit of advice. There are a lot of tools out there. One thing you don't want to do is give up on a tool too easily, because I was hopping from tool to tool so many times. And it wasn't until I just said, you know what, it's not the tool, it's me. I need to be a little more dedicated to learning the tool so I can use it correctly. That's why they got this big question mark here, so you can ask questions and whatnot. So that's just there. But this is YNAB. This is a budgeting tool that I use. I don't want to say daily, but at least once a week, I try to look at what's going on, especially when I get paid. I added a couple of things here, Francisco and Juan, that I thought might be useful too. So these right here on your left side are your accounts, right? Some of you have more accounts than others. But these are some that some regular default accounts that I made. If we look here, you have a credit card that has a $566 debt, and then here, credit card over time. I named it that. You'll see why here in a second. But this is 2321. Let's say you got a couple of TVs, and you're gonna do 18 months financing, and you're like, hey, I'm gonna beat that. I'm gonna get 0% financing on this. No big deal. So this is your account, and then you just add a transaction. Like, let's say you go out to Walmart or something, and you right here you pick your category. Well, you know what? Before I do that, let me show you exactly what a budget looks like. So this is your budget. Essentially, these are all the different expenses that you have. You have some that are credit card payments. You have some that are immediate obligations like mortgages and electric, water, internet. These are things that you know for sure you're going to be having all the time, and that you have to pay them, because if you don't, you won't have any electricity. Nobody wants to be there, right? These are true expenses. This is a word I really don't have a full grasp on why they call it that, but from what I've learned, it's basically things that you want to prepare for. So I'll give you an example. Yesterday, I was supposed to meet with Francisco and Juan, but my wife's car battery went out, and she's a nurse, so she's sleeping during the daytime. So I'm like, I'm not going to wake her up, and, or I got to be there for her basically. So I go over there, and I had to buy a battery that was like 200, or I can't even remember right now. But let's just say it was like a weird number, $160, right? So hopefully at some point I will have saved, $160 to cover that expense, right? And then these are other true expenses that you can have. One thing that I really enjoy, if you have car insurance, I'm all about saving as much money as possible. So let's say you have car insurance, And I don't know if you guys know this, but if you pay everything up front, it'll save you anywhere between $50 to $100, which to me, that's like another night out on the town. You can go out and get something to eat. So, I can set a budget, a goal of, I can set a goal and I say, okay, my insurance is, let's say $1,200, and that's for 6 months, right? And I do the math and I say, okay, we're in May. So 6 months from now, which would be 2021, I set the goal right there. And today, all I have to put in would be $85.72. And then next month, it'll tell me the same thing. I'll say, okay, I need to set that much. And you'll notice that this is creeping up. And then next month, you do it again. And little by little, you're saving, I call these little banks, like you're literally saving away money for those specific ones. Now, here's the beautiful part about it. Let's say you have an emergency and you have to do something like, you know what, this month I'm only gonna have $40 for this account because I need to buy something else. It's telling you, hey, you're not where you wanna be, but next month it'll still tell you, hey, let's put this here, and now you're in the green again. So you're ready to go for next month, and you're still on track. You can also, I personally, I'm gonna start, I wanna start real estate investing. I think that if I have 50,000, I can do that. I would set a goal for 50,000 and then put that money away, and it's all tracking it. As you make, charges, you'll notice that, okay, groceries outflow, right? I spent $200 on groceries. I'm gonna save it and then I'm gonna clear it, and you'll notice that up here, eventually, when you go down here, it's gonna say, what did I say here? Sorry, I thought it would be right up there, but let me see, groceries. Yeah, here. Oh, I'm sorry, because we're in the wrong month, right? So go back to May, and you'll see that now we're in the zero. So now I should have started from the checking account. Your checking account was originally $4,000. It took it away from there. But you want to know that where it's at, right? So this is how much money you actually have. So now I'm going to put down the $200, and now you're at zero, so you're good. If you did another one, but if you, let's say you planned ahead and you say, okay, normally I spend about $500 a month in groceries. It's going to say this is how much you have left, and as you create purchases, it'll track that for you. Also, it connects to your bank account, so it'll let you know how many different charges are being made, and it'll import them for you, and all you have to do is clear them. And then and now this is the cool part too. I'm sorry, this is where I'll just go here. Your mortgage, let's say it's $1,200 a month. You have that much money to spend with. Your electricity is $90 a month. Water is $40 a month because you like to water your grass. Internet's $120, it's getting expensive. And groceries, we already did that. And then transportation, your car. Let's say you just want to do a monthly car payment of $315. So this is how much money you have left that you can put aside into other things. If you like Dave Ramsey, you can definitely have a $0 base budget. Let's say in savings you want to put 1,000. Well, that's cool. You're saving 1,000 a month. Good. Look how much money you still have left. So that's just kind of the gist of it. I don't know if there's any other, maybe we can have some questions later on. But I love YNAB. If you decide to get it on your own, let me know, and I can help you with it if you have any questions. Do you think that I do okay? I'm like, there's so much about it that I feel like I can go on forever.
That's fantastic, Paul. I love it. It's super helpful to see tools like that. I personally use a bunch of them. I use Mint. I've tried Clarity Money was one that my former employer bought out. A shameless plug. I'm building one myself. We'll see how it works.
I'm rooting for you, man. I will gladly replace YNAB.
Mostly it's broken. Anyways, I think the next part about money that I think is one part that is underappreciated, and I think the one area where I really disagree with Dave Ramsey is debt. Right? Debt sometimes seems like this scary creature, this evil thing. And we're going to talk a little bit about that. So what if I need to borrow money? Maybe, you know, sometimes in life, and I know this, right? Like you have a budget and you still don't have enough, right? And that's okay. You know, life is complicated. So sometimes you need to borrow money, and that's fine. There's nothing to be afraid of. There's nothing to be ashamed of. There's nothing wrong with it. It can be a really, really powerful lever to help you build wealth in some cases, actually. And so some of the questions that we want to answer are: what is debt? Is it bad? You know, what's credit, and how does credit impact you know, my ability to take on debt? So I want to start with a simple example, and you know, this is probably my favorite example. But credit card debt is a pretty common area of debt for lots of folks. I know my first experience with debt was, you know, I worked my way through college. You know, one night when I was driving, I hit a pothole on my Honda Civic, and this thing had been through with me had for a long time, right? This car gave it its all, and the pothole snapped off the tire, and you know, we called it tow, and they fixed it, but you know, it was it's like nearly $2,000 to fix it, and you know, obviously I was working my way through college, I didn't have a lot of money, but fortunately I had been banking with a bank for a while, and so they gave me a credit card with a small credit line, and I was able to pay for the purchase on my credit card, and that was great because it helped me fix my car, and I was able to start working again, right? And it certainly was stressful. I was freaked out about it, but it helped, right? Now the challenge with that was that the interest rate wasn't great, you know, because obviously I didn't have a huge credit history, and so, you know, luckily, even though I didn't really know what I was doing, I was thoughtful enough to say like, oh, I guess I have to pay it back, right? Or what happens? I didn't know that, you know, I actually had more time. I thought I had to pay it back right away, or I was going to get like bad. I don't know. But a high APR can actually be really impactful, right? And what happens to a lot of folks, a lot of people, is that they end up paying only the minimum balance on a credit card. And the problem with that is that if you only pay the minimum balance, because of that compounding, you can actually end up in a really, really bad situation. And so the example I give here is, you know, if you borrowed, you know, in my case, you know, where I had to fix my tire, you know, it was like $2,000. Maybe you borrowed $1,000. Maybe you had to fix your car, right? And it cost $1,000. You pay for a credit card, and you had a 20% APR, which is actually pretty moderate to low rate for a credit card. If you only paid the minimum monthly payment, one, it would take you quite a bit of time, you know, almost 5 years. And two, you would end up paying 60% in interest back, right? You would pay $1,600 on in total when you only borrowed $1,000. Now, you don't have to do a lot of math to say that, like, wow, that's expensive, right? Like nearly double. I mean, some pretty strong rounding, but still, you get it, right? Debt is borrowing money, you know, and really the three core components of it are the price, which is the APR, right? Like in this example, I gave you 20%. The term of the repayment. For a credit card, it's revolving, and the revolving means that you're allowed to add money back on the card every month if you want to, so long as you're still above the credit limit. So very explicitly, if you have a $2,000 credit limit and I spend $1,000 one month, I can still spend the other $1,000 so long as I'm making payments. And then three, you know, the risk of the repayment. So if I'm, you know, new to a credit and I have really, really high risk, it'll have a higher APR, usually. And so the next part is, you know, is debt bad? It's not. It's not bad nor good, in my opinion, right? I think debt is a tool. You know, tools can be really, really powerful, but they can also be dangerous, right? You know, one of my favorite examples of you know, debt being a good tool is a mortgage. A mortgage can be a really powerful way for you to build wealth for generations, right? For your family, for your kids, for people you love and for your partners, right? And when you have good habits, like you're intentional with your money, when you're budgeting well, when you're paying your mortgage on time, um, you know, debt can be really great, right? Um, but if you don't have good habits, it can be a big problem, right? Because what can end up happening is you're not making your payments, your credit's going down, you're growing your outstanding debt balance, and you end up in a situation where you compound your debt into such a big mass that you end up having to file bankruptcy. And this happens to lots of people. It does. More people than I think fully appreciate it, you know. And you can go and read about it from the bureaus, or you can go read about it in publications online. And unfortunately, it just comes from not necessarily bad habits. Sometimes people aren't paid enough, and there are a bunch of societal issues about why. But sometimes there are some things that we can do. There are some things that we can take control. And one of the things I wanted to emphasize with this example was how easily it can churn, right? And so in this example, you know, what I was assuming is someone, you know, just starting working, you know, which is reasonable. A lot of that happens to a lot of folks, right? You don't have any money. I know I didn't when I first started working, and that's okay. That's great, right? You're getting your first job, and you suppose you get a job for $50,000, right? And you're managing to balance your budget. In that second month in February, you have a surplus. That's that green bar is in income, right? And you decide to pay a little bit of your debts, the red bar, right? You're paying a little bit more than the monthly payment because you need to build up some cash, right? That's a good thing. And fine, you'll pay compound interest, but you'll still chip away at it, right? And you know, you have your expenses because maybe now that you're working, you move out of your house and move to, you know, a place by yourself or something, which are all reasonable things to do. But suppose within 6 months, you know, something happens. Maybe you get sick, or maybe you lose your job, because that happens to people. It happens to good people. It happens to good, hardworking people. Sometimes for just things outside of our control, like a pandemic, or the company just didn't work out. And then all of a sudden, you have all these obligations, like rent payments that you've already been obligated to, or mortgage payments that you've already been obligated to. And then, you know, the credit card debt, because it compounds monthly, it starts to grow. And then you add in the expenses that you have to meet because you've already signed up for these things. And you end up overburdened. You end up over leveraged. And that can be a really, really hard spot, right? And so that's why I try to say that, you know, debt can be great, but debt can absolutely be bad. But that's not to say that debt should be treated as this like villain. That's just the thing. It's how we use it, right? That we have to be cautious of. And so we have to be thoughtful to make sure that we use debt when it's appropriate, when we think we can benefit from it, but we also manage the downside risk of it in the worst case scenario, right? And this doesn't happen to everybody. This doesn't happen to, fortunately, it doesn't happen to most people, but it does happen to some people. And I think for me, I try to be conscious of this just to make sure that I know what the worst case scenario is, and I know what the best case scenario is, and I can manage both.
And just to add to that, I think going back to the budgeting thing, once you're able to feel comfortable and can handle these situations with the budgeting, it's going to help you utilize this tool of debt a lot better and understand it a lot better going forward, which is going to put you in a big surplus from a knowledge perspective on when to use it and when not to use it. So you know, just keep adding to that and keeping that into mind.
Yeah, and then I would say when it comes to debt, find out who you can ask questions to. Like I'm always calling I'm in the process of refinancing my mortgage right now, and I know who exactly to call, and I'm asking all kinds of questions. I play dumb. I don't know what it is. You have to explain it to me. It's your job to do it. Yeah. Juan hit it on the head. I mean, that's the whole point of the budget, is to allow you to be at peace with the decision you make to take on the debt. And then something this is going to be like a pro tip. If you save $500 and then take out a $500 credit card, you already have those $500 ready to pay off any debt that you take with that $500 credit card. So that's something you can do prior to taking out a credit card or taking out the debt, trying to save that amount of money already stashed for it. That's what I did when I first got a credit card. And then whenever I, took out like, $20, $30 or whatever, instead of taking from that 500 that I saved, I would try to pay it with the money that I would get from my checks. That way I know that I can manage that amount, but that 500 would be ready there. And of course you would be saving a lot more anyway. I mean, hopefully if you take charge of your budget.
No, I definitely agree. So now moving to credit, right? And this is where I spent a big portion of my career on it. And so it's an area that I'm really passionate about. I think there's a lot of interesting stuff you can learn from it. And at its core, credit is really just an agreement between two people or entities about money now in exchange for money later, plus, a charge, a fee, right? And there's a ton of examples: the credit card, mortgage, student loans, pretty much any purchase with a monthly payment plan. And the credit reporting process is highly regulated by the Fair Credit Reporting Act. It's often called FCRA. And it's managed primarily by the bureaus, right? And so the bureaus are the three big ones: are Experian, Equifax, and TransUnion. And it's a very tightly regulated system of checks and balances to say that if I'm a bank or a lender, sometimes they're the same, and I lend you money and you pay me back, I have to document that to the bureaus. So that way, when some other bank wants to potentially lend you money, they have proof that, you'll pay them back, right? And sometimes that's not well done. Sometimes it is really well done so that you can actually have access to debt. Because then it can actually help you out in really great ways, like I said in the mortgage example. And so all that said, right, having good credit is very, very critical for your financial wellness. I cannot emphasize enough how much having a good credit score really can set you up for long-term financial success. And sometimes it takes years to get there, right? There are some certain things that you can do early on to set yourself up for success. But it does take years in planning to get it right. And then most of the stuff isn't super hard. It's just making sure that you do the right things, like always paying your credit card on time, right? Because if you're delinquent, which is you missed a payment, it will impact your credit score because they'll have to post that to the bureaus and it'll be reflected. That you're not what's called overutilizing your credit cards. So utilization or credit utilization is basically how much credit you've used of your outstanding available credits. So if you have like two credit cards, both for $1,000 each, that means you have $2,000 in total credit available. And if you've spent like $1,000 on them, then you're at 50% utilization, right? Because 1,000 divided by 2,000, 50%. And usually a good rule of thumb is that you want to keep it below 30%. And it turns out that as like a predictor for default or for you not paying the bank or lender back is really, really important. And so what you want is a low probability of default, because that's what they're using to try to predict whether or not you'll pay them back, right? And you'll hear things like FICO score or a Vantage score. And these are all things to try to approximate how likely you are to repay people, right? So the higher the likelihood you are to repay them, the lower interest rate you're gonna get charged. And I'll go more into that a little bit later.
One thing that I will add to this as well, at least from my perspective, working in the fintech space, especially in the lending part, credit was actually one of the things that they were looking at, apart from the skills that I had from my finance side and my technical skills that I had from my coding side. So that also could potentially come into play for whatever role you might want to seek in the future, especially if it's in the finance world. That is something that applies. And like Francisco said, it's not rocket science. And I'm not going to say you can manipulate the system, but it's once you understand how it works, you can use it to your advantage.
Yeah, I will say mathematically, you can definitely game it a little bit. It's in fact, there's a proof by Leo Brainman somewhere out there in the world that if any given algorithm can be broken. And these FICO scores, Vantage scores are algorithms. Some of them aren't amazingly sophisticated. Some of them are, but even the amazingly sophisticated ones aren't that much. And so you can work your way to serve to your benefit. And I invite you to explore opportunities and make sure that your credit is behaving on par with what you hope, what you think is good for you, and making sure that you're preparing yourself for the future. Right.
And I wanted to just add to that. Well, no, I think you're going to answer it here. Never mind.
Are you sure?
Yeah. I just like that last bullet point, but you'll go.
Oh, what? Well, let's go to it. Yeah.
No. On the right, on the next, on the one you're about to talk about.
Oh, yes. Okay. So now to emphasize how credit impacts your ability to take on debt, this is an example of, again, right, the last time in that simple calculation I showed you that a 20% APR on a $1,000 credit card meant that you'd pay 66% back in interest, right? Thus, you end up paying total $1,662, right? And I can tell you that having a high credit score means that you're on average, not always, having a higher credit score means you'll usually have a lower APR, a lower interest rate. And just as an extreme example, if you had a 0% APR, then you borrowed the money for free, which is great. Cheap debt is great. And we'll go more into that in a little bit. But if you had a 15% APR, then it costs you nearly like 40% to borrow that amount of money, right? But if you had a 25% APR, then it costs you more than double, which is crazy, right? Because you only borrowed 5 percentage points more at a price that's 5 percentage points more. But again, how this compounds over time, and because you're only paying, in this example, it was $25 a minimum monthly payment. Mathematically, this is just how it works out, right? And so a small change in your percentage can cost you hundreds of dollars. And if you're making a bigger purchase, right? Because many folks have credit card debt in the tens of thousands, and it gets really big really quickly, and it can be really painful. So you want to be mindful of that. You want to be able to mitigate those problems as they arise. And so in addition, you want to get cheap debt. If you can get cheap debt, that's amazing, right? I think I remember once I figured out the credit card stuff, I bought a MacBook many years ago from Apple because Barclay Card was offering a 0% purchase for 2 years, which I was like, that means I'm getting a laptop for 0% for 2 years. That's free. That is absolutely like free money. In fact, because of inflation, that value is depreciating over time, right? So that $2,000 in 2 years, it's worth less, right? And so I actually ended up benefiting from it because the moment the 0% interest, was no longer at play, I just paid it all off, and it was like, okay, fine. And so you end up on the upside. So you want to be able to manage using cheap debt when it's available. Now, the one thing that I'll say about that is don't always just open up credit cards because it will impact your credit score. It will actually post what's called a hard inquiry when you actually formally apply for a card. So you want to balance all these things, but that's probably a deeper dive conversation.
Yeah, I was gonna say like the rule of thumb is pay everything off as fast as you can, right? If you want to learn all the tricks, I mean they're not really tricks. It's just staying on top of your credit game. How you said about the 0%, I was telling you guys before. It's like I know for a fact that the whole 3 month, 6 month, 12 month, I'd say a fact, but it's my opinion that they count on you to fail. So
Yes.
I look at them as like, nah, I'm not gonna. You're not gonna do that to me.
Yeah.
That's the way I look at it. So I want to get that 0% all the way through.
That's exactly right, and that's absolutely what you do. And they're on the upside, just mathematically, right? If you're not able to fully pay it back, but if you can, then they lose money, right? I mean, so that's not a judgment decision. That's just a mathematical fact. So when you think about it that way, then it's just like, oh, okay, there's no emotion here. This is just me on the upside. So what I wanted to kind of, and this is the last slide we have here, and Juan can talk to it more, was emphasize kind of the extreme use cases of how you can use debt in a great way and misuse debt, right? And Juan, please feel free to
Yeah, so basically, when we talk about debt and we're giving these explanations going forward on what is debt and how to use it and how to use this as a tool, we have good uses of debt and bad uses of debt, right? But before we get into that, I think there's always, we need to separate what is good debt and what is bad debt. And these things can cross the line depending how you're using them. So for example, if you're using debt as a matters of a mortgage, where you're now going to have a consistent monthly payment that you know your rent's not going to go up and you're able to do that, and at the same point you're getting equity, that is a very good use of debt going forward, being responsible on what you're buying and what you know you're buying and you can afford what you're buying, right? And then one bad way of that is, for example, opening cards at department stores. It's very hard to, no way that you shake it down, department store credit card like Macy's or something like that. There's just really no upside on getting that type of debt, apart from whatever 5-10% that they're giving you on your first purchase for opening the card. But then we get in here, what we see is a gray area, right? A gray area is, for example, you can get into a car loan. Car loan can be very good or it can be very bad. So for example, if you have an older car and you have the mentality of like, oh no, I'm just gonna ride these things until the wheel falls off, but you actually end up spending more money throughout your year repairing that car because it's older or whatever the case may be, and you're $2,000-3,000 in repairs. If you're not carrying a budget to know that, you wouldn't even know that in your mind, where you're just saying, oh, this thing just broke down, whatever the case may be, whether you might actually be able to go buy a car and it's going to cost you the same and relieve that from your life from a headache, or even cost you less than that. So, that from that example, that's a very good use of debt. Now, if you go buy a car that's, outside of your budget and you don't know what that budget is, that's where you can get in trouble. Or going to a dealership and buying, for my example, I'm not very favorable of going to go buy new cars. I understand why people do it, but as soon as you drive off the lot, you're essentially in an underwater loan. And underwater loan means that basically your asset is worth less than what you can go sell it for in the street or sell it to a dealer. So if anything is to happen to you or to the car itself, now you're in a situation where you took on debt and you don't have that coverage. That's why insurance company sells you the gap coverage situation. So there's a bunch of ways to mitigate these things, but one thing that I want to make clear is there's good ways to use that and bad ways to use that. And you have things that are statistically, if you're using that to buy a mortgage, most times than not, regardless of the situation, you're gonna come out okay at the end of the day in case something does happen. But once you get into what we call credit cards and car loans and things of that matter, that's where it's a gray area. If you're disciplined and you're like Paul, where hey, I'm spending this stuff on the credit card, but it's because I need to get the points, because I want security. I don't want to swipe my ATM debit card everywhere, so a potential hacker can have access directly to my money. Because at the end of the day, as this stuff is heavily regulated, I'm telling you, coming from the industry, is from a security aspect, I think it's very dangerous, because you don't know how these companies are managing their infrastructure, and you don't know at the end of the day what's happening on the back end, or they might have some type of security leak. So if you're utilizing a credit card to make these type of payments, at the end of the day, if something does happen, it is the bank's money for them to figure out what happened instead of your own money that has been pulled out, and now you have no resources or tools to figure out and solve this problem. But when you start using credit cards to supplement a lifestyle or supplement expenses that you don't really get on a daily basis, that's where you start seeing the upswing of the other way around. And it's very hard to claw out of that, especially when you just keep doing that for years and years. I mean, I know many people who they play the trick of, they use credit cards on their lifestyle, and what they do is they just, as soon as their 0% APR is up, they just go apply for a new one and roll over that debt, and they just keep rolling that over, and before you know it, they're 30, 40, $50,000 in debt, and that's a situation you don't want to be in as well. So just reinforcing that is you got to know how to use it, and as when you have your building blocks of knowing how to budget and you work on that, identifying, and there's a lot of tools out there and a lot of educational content out there on how to do that. And my main advice in this situation is educate yourself. Educate on any type of financial situation that you're going to make. If you're going to go purchase a car, understands the downside of purchasing that car, understand what a good rate is and what a buy rate is. Understanding is leasing maybe a better vehicle for me than it is going to go buy a car, right? But that's a whole other subject that we have to kind of get into and understand. And yeah, I mean, I think the biggest thing to do is also to reinforce yourself financially, because to be able to utilize these tools, there's certain things that need to happen beforehand. So for example, when you're going to get a mortgage or you're trying to buy a house, there's certain things that you need to do, such as you got to have making sure that your credit is good and strong, but not apart from that, your financial needs to look good. Because once you go into underwriting, they're looking at all your financials. They're gonna ask you about, that $5 Starbucks coffee that you're buying every single day and telling you, hey, what's going on here? And there needs to be what I call a financial fitness around that, and making sure you're in good shape to take on those types of debt. So you want to make sure you do all that work, so you take on good type of debt and make sure it's going to help you down the line, compared to, you do all that work to get on debt that's not going to help you. It's not going to help you later down in life, and essentially end up in a spiral and momentum. I think the biggest thing, and trust me, I have seen people who have come from nothing and make a good financial situation for themselves. So don't think that because you might not have money or you don't make a lot of money, that's not a factor at all. It's all about educating yourself and utilizing it wisely. Money doesn't discriminate on how tall you are or where you come from or what age you are. It is the most transparent thing out there.
No, so that's most of our talk, right? I think the last half we actually covered in the last talk. Right now I know we're running a little bit longer than the last one, but we do want to give time for folks to ask a ton of questions if they're interested. I see that the chat is pretty active. Thank you, Omar. I love it. Please feel free to ask questions. We'd love to share some.
I want to mention the tip that he gave, which is something I did, because I had credit history before my wife did, and I was trying to get her to get good credit too. So when we bought our first house, one way you can build someone else's credit up is by being added as a authorized user on a card, and they may never use it, but they still get the credit history. And that's kind of how we got her going. And now she actually has a better score than me. I'm a little mad about that, but whatever.
Yeah, and one thing that I would caution about that tip as well is, I think if you have the ability to use one of your parents that might have a good credit score and they might just have a credit card that's stored away somewhere, I think that's great, and if they're able to help you out that way. But keep in mind that if they're doing that, you also are going to want to take out at some point a credit card from your own to leave there. And because, unfortunately, that account that, your mother or your husband or whatever the case may be is there, could get closed down later on for whatever XYZ reason. And one of the impacts in your credit score is age history, right? Or credit history of the amount of time you've had these loans. And if your oldest cards ends up being the one that's from that authorized user and the card is closed, you can maybe, let's say you have two cards, one you'll have that you've had 8 years with that authorized user, and you opened up another card that's, 2 years new. Well, it takes the average of that, and when you close the older card down, that average age history of the credit line goes down way much. It could impact your score negatively, and that's one of the factors when you're building credit that is not so easy to manipulate because it's just time.
Yeah, and
So,
that's one way to. Oh, sorry, Juan.
no. Go ahead.
One way to approach that, and this one's a time thing, right? Plan for your kids is, when they're at an early age, put them on all of your cards and transition opening up new ones for them early on so they can build the credit history, and then start to close that off so that that you're cascading the average shift, moderately, right? Like, because if you start off and you have 30, you have like 3 cards, average the 30 of them. If you have 3 cards with an average of 30 years of credit history on each of them, then when you add a new one, you're doing 90 plus 1 divided by 4, right? And then over time, as you start to open up new ones and shift those over, you're not dramatically shifting the average as time goes on. So in like 10 years, it'll impact it still, but it won't be as dramatic.
Yeah. So I've been on the positive side of this where I actually had credit since I was like, I don't know, 13 or 14, but how that ended up being rolling around is as soon as I turned 18, my parents actually told me, hey, go get a credit card and just don't use it. That way, when you're 2021, and the neat part about it is when I went to go get a credit card, I was able to get it at a lower APR because I did have a credit history.
So,
and I didn't even know this was really happening, but I had I was lucky in that situation to be able to be in that, that had set me up for myself.
Yeah.
But that's something to think about, right? And, going in, and I remember also when I was buying my first car, I was like 19 years old or something. And the car to the dealership was like, how's it possibly having over 800 credit score? And it's just like, I'm looking at the guy and I'm like, I kind of don't really know, but obviously from those situations,
right?
Yeah.
And that's something that you have to think about yourself as well. If you want to have children in the future, is how do you build good things for your kids as well? So these things will be helpful for them. One thing I want to answer is some of the questions here, because I think they're important. Can lenders decrease credit limits? Yes, Paul, it is because they're mad, but it's also because there's reserve requirements. So reserve requirements are basically banks have to hold capital about for whatever amount of money that they've assigned you. So if you have a credit limit of $1,000, right? There's a certain amount of money that the bank has to have in cash that they can't invest to other people for that allotted amount of credit, right? So what lenders will often do is they'll close down lines if there is a sustained period of inactivity because they're not making money off of that money, right? They want to make money too. That's fine. And, respect it, love it. And so it is one thing to be mindful of, that inactivity of a card could get it closed out. And I don't know if they're legally required to give you notice before closing it. I don't know, to be honest with you.
I don't think so, because I've gotten it so many different times. Ashley Furniture and stuff like that. And the thing is, though, when I go back and I ask them, it's like, can I get my credit up? And I'm not giving Ashley Furniture a plug. Don't go shopping there. I don't like them one bit. You want to hear that story? I'll give you that story. And the funny thing is, I am super cynical about credit card companies.
Yeah.
It's a gift and a curse, because I'm like, man, you are not getting me. I'm not going to allow this to happen. And so that's the first thing that pops in my head when, you don't want to give me that same credit anymore. Okay, that's fine. I was going to get that power tool, but now I'm not thinking about it.
Yeah, that's all right.
Yeah.
So I want to one quick question is, I don't want to use my oldest credit card anymore since it's a retail card. You can absolutely use retail cards so long as you're using it healthily. Then that's absolutely fine. So make sure you're paying off the full balance so that you're getting the rewards
Well,
from it and you're
well,
keeping.
you got to be careful because some retail cards, even if you pay off the balance every month, they still charge you the interest.
Well, that's a good point.
Or the yearly, or the yearly, or the yearly.
Yeah, some of them have an annual fee. Yes.
Yeah, they have an annual fee. But I think his question was more like, I didn't want to use it anymore. Is it okay to just keep a zero balance? Which I've done that with numerous cards, and I've never had a negative,
No, yeah,
negative
it's just
about, yeah.
yeah,
But
just keep.
Juan makes a good point that if you have a balance, they might charge you the interest on it, even if it was a short period. So if you spent like $500 on it, maybe they'll charge you like, on the $500 expenses, right?
But there's no repercussion if you just leave it at zero and leave it, in a drawer somewhere. You cut up the card. There's no negative impact to the person. The only thing you might run down the road is that department store might say, "Hey, we're gonna close down the account because of inactivity," right? So
Yeah,
just
yeah.
prepare yourself for that and make sure you're working yourself towards that going forward to make sure that once that happens, it doesn't affect you as much as it would.
Yeah, and the only effect is you don't have that amount of credit in your, like, let's say for instance, so the golden rule is to keep it under 30%, right? I mean, honestly, I would never get near that, but if let's say for instance your $500 credit card gets shut down because you're not using it, well now instead of having, let's say, 20,000, you have 19,500, so that might actually affect your 30% mark. So that's something to keep in mind too.
Yeah,
Exactly.
yeah. Yeah, but I think, Paul, the question was more of because that's the oldest account that she has
Yeah.
Mhm.
in the credit age history. That's gonna be her biggest impact apart
Yeah,
from.
oh yeah, 100%, yeah.
So, and this one's with respect to the environment that we in. Yes. So you like one of my old colleagues used to run Capital One's credit card business, and one of the things that Capital One was very intentional about, and this is true about Discover and some of the other players, is that during times of economic recessions, they'll often contract their credit policies because they know the losses are coming. So the lender knows that they're going to start losing money, and that's fine. What they do is they react to it early to make sure that they manage their own risk, which means that people will have their credit card limits reduced, or they could have their credit cards closed out, right? Because what they want to do is they want to manage their risk. And I get it. They're a business. They have to do what they do. Know how that impacts you and make sure that you manage your financial health appropriately to counteract that, right?
I actually do have a story behind that as well a little bit. Sometimes what I've seen done, and I had a talk with this somebody who works at American Express. The way that they did it this time around, like a couple months ago or last month, is they actually ran an algorithm to see who was doing outside of normal spending to reduce the credit lines for the ones that weren't charge cards.
Yeah.
And for some of the people, all they did was just call in to the bank and say, "Hey, I pay off my credit card every month. There's really no issue." My kind of reassure them, because some of these times when the decrease is happening, it's an algorithm doing them, not a person looking at your account.
Exactly.
And they can go ahead and just put your account back up where it was if they see that you pay off stuff every month, or it was just maybe you were moving that month, or where the case may be. That's one way to combat that.
Yeah. There's speaking as a former developer there are a lot of algorithms that play they're heavily regulated, but there are a lot of algorithms that play. Some of them aren't, like I said, super sophisticated, but it's important to know the rules and regulations at play. These are very, very tightly regulated by the Consumer Financial Protection Bureau, by the Fair Credit Reporting Act, and by external auditors, whether it be the Federal Reserve or different regulatory bodies in the government. It is a very well managed structure, but that said, you want to know how that impacts you, right?
Yeah, to the next question, Francisco, and I think you might be able to answer this better because I actually don't know the exact answer, but for the how many open accounts is good to have. I've just seen it where is from my perspective, the more you have is the better, but I'm not sure how that plays exactly into the score itself.
Yeah, I mean, so like realistically, it's like a logarithmic return, right? So it's like it's a diminishing marginal returns, right? So like you have to have at least some base, but after you hit some number, and it might be like seven-ish, maybe a little bit more, maybe a little bit less. You know, adding another account doesn't really change your score that much. If you, so long as you have like maybe three, you're already in a good spot. Adding another three, sure, that helps, but adding another three on top of that, where you have like nine, is it really getting your bang for your buck? Like, no, not. And it's not because there are so many factors into it. It's a multivariate equation. It's not trivially like to say like, oh yes, more is better. It's a little more complicated than that. But having at least a sufficient amount, maybe seven, maybe a little bit more, is a good start. But then you have to balance that with how that impacts your average age of credit, right? And that's why I said it's like it's a little bit of a multivariate equation, is what it's called.
Well, and the hard inquiries too, right? Because you might
Yes.
be trying to gain some points on having more accounts, but you're actually going to end up losing more in the beginning because of the hard inquiries that you're doing.
Yeah, but the hard inquiries, they stop caring about them after like 6 months usually. But yes, absolutely. If you try to bulk load it, like, oh, I just turned 18, and you open up everything, that will impact your score.
We have another question from Wendy. It says, how does closing the card after paying off the balance affect credit? It doesn't. Actually, it can help you, but don't, if you're closing your oldest card, it can. So you got to figure out which card you are closing. Because let's say you opened up a credit card and you're just going to utilize it for 6 months and you've only had the card for a year, but you had another credit card that you've had for 10 years, and you know that's the one that's leading your credit score for credit history, then it wouldn't be so much that situation where it's going to impact us more. But going forward, if you pay off a credit card that you had for 10 years, it's actually more useful to you to just keep it, pay it off, cut it up, put it in a drawer somewhere and forget about it and just make sure the account doesn't get closed. That's actually going to be more beneficial to you down the line than just closing it.
And you can literally spend like $5 on that card and then keep it open. And I do that for some things, and even if there are some cards, and I don't recommend this for everybody, that I do pay an annual fee on because the points over the year is worth it. But then I also think about mathematically what the APR adjustment would be if that hit my age of oldest score. And so I actually eat the cost because I know that it works out to be worth it.
Oh,
On
and another tip is usually if you are paying annual fees for a card, usually on that deck of products that the bank is showing you, sometimes they have a downgrade path where if you don't feel like you can afford or want to pay that annual fee, you can downgrade that to the free version. It might not have the same perks, but from a credit perspective, that's not changing anything.
yeah, that's absolutely true. Any other questions?
I'm over here saying no. Like I'm like, nope, I don't have any questions.
And feel free to also jump on the mic and talk about it. It doesn't necessarily have to be on the chat.
Yeah, everybody, you got a couple of people saying thank you. No, thank you for coming in. Honestly, guys.
And thank you all for giving us the opportunity. Thank you, Tecaria. Thank you to Juan and Paul and Carlos and everybody. Um, love talking about this stuff. And yeah,